I'm Matt Bichard here in New York City for NAREIT's REIT Week, the 2018 Investor Conference. Joining me today is Craig Leupold, CEO of Green Street Advisors. Craig, thanks so much for joining us.
Thanks for having me.
Obviously, REIT valuations are in the news a lot. What is Green Street's valuation approach, and how has it changed over the years?
So Green Street's primary valuation approach has always been to determine the private market underlying real estate value of a company's assets. That's the starting point of our valuation methodology, because then we look to determine what sort of premium or discount to NAV a given company should trade at based on a variety of variables. You can get into a deeper understanding of our methodology on our website if you go to the methodology section of our website. But that's the starting point. About 5 years ago, we launched a new product line called Real Estate Analytics, and Real Estate Analytics is focused on private market fundamentals and return expectations. And as part of that, we spent a lot of time to understand the long-term NOI growth prospects for a given market, submarket, or zip code across 50 MSAs across the major property sectors. So we can use this tool to help us assess where pricing might be amiss in the market. And now our analysts on the REIT side are using the outputs from our Real Estate Analytics product line to add and calculate, or I should say to calculate, implied return expectations or implied IRRs for each of the companies in our coverage universe. So it's an additional tool that we use on top of our traditional NAV-based methodology to help us form our investment recommendations. And since we've been using this tool, it has enhanced our already solid performance of our buy-rated stocks, and our analysts are doing an even better job than they have historically of picking stocks using this incremental tool.
And sticking with topics in the news, interest rates, it seems to be on everyone's mind. What effect do you think that interest rates have on real estate and REITs?
Well, real estate is a capital-intensive business, and it's also a business that is directly tied to other capital market alternatives. It's return expectations and valuations. I think, at Green Street, we're not interest rate prognosticators. We think it's sort of a foolhardy task to try to think that we can predict what direction interest rates are going. So instead, we prefer to measure real estate and the returns available from real estate relative to current capital market alternatives, primarily focused on interest rates and what kind of equity risk premium real estate investors are being afforded given current interest rates. As we sit here today, we think real estate is sort of fully valued in the private market. In the public market, REITs are trading at a discount to that underlying real estate value. Now, having said that, when you think about what is the impact of changing interest rates, you need to understand what's driving the change in rates. Is it an increase in real rates? Is it an increase in inflation expectations? Because real estate does offer some inflation hedge characteristics, or has some inflation hedge characteristics, meaning that if we have strong economic activity, strong inflation expectations, that could lead to better rent growth and occupancy growth, which should improve the top line for REITs and therefore their net operating income, and for real estate. Having said that, higher rates are a headwind for real estate. They're a headwind for REITs. In fact, we recently did an analysis looking at rolling 2-year returns of REITs versus the S&P 500, and the data clearly shows that over rolling 2-year periods, in a declining interest rate environment, REITs tend to outperform the S&P 500, but in a rising interest rate environment, they tend to underperform the S&P 500.
And lastly, with increased activism in the REIT sector, and we're starting to see a recent flurry of M&A activity, what is Green Street's overall outlook for the REIT industry?
Green Street, we've been fortunate. We've covered the REIT industry since it was a $3 billion market cap industry. Today, it's a $1 trillion market cap industry. We'd like to think that Green Street has played an important role in helping to shape the industry by ensuring that we have best practices in the industry, and whether that be around corporate governance or balance sheet strategies or capital allocation strategies. We like to make sure that we have the best companies in the industry to further the growth of the industry. We see activism as sort of the next step in that, and we welcome activists in the sector in that they provide another check and balance for REIT management teams and REIT boards to ensure that they do the right thing. Over the short term, currently we see an opportunity for privatization and M&A activity, because we're seeing several REITs that traded, meaningful discounts to underlying real estate value. Meanwhile, debt capital is readily available in the private market, so we expect to see further privatizations. We expect to see M&A activities. We see different valuation multiples across companies, and we think that we might have some, in the short term, a reduction in the number of REITs, but that's probably good for the industry over the long term because it shows investors that REIT management teams and boards are doing the right thing by shareholders. And so long term, we're very bullish on the REIT sector. We believe, especially for core real estate, REITs are the optimal way to own core real estate. They provide transparency, liquidity, daily pricing, alignment of interest. And so that's, these are all traits that investors should seek when they're looking for their capital allocation decisions or making their capital allocation decisions within a real estate sector.
Great. Craig, thank you so much for joining us.
Yep, thanks for having me.
For more from NAREIT's REIT Week, be sure to visit NAREIT's website, REIT.com.